Well, Eric Robertsen is the Global Head of Research at Standard Chartered Bank, joining us now from Sydney. Great to see you there, Eric. No deal yet when it comes to stimulus, but markets still at record highs. Is this more a case of buy the rumour and then eventually will we see selling the fact?
Well, I think it's actually markets trying to take a more medium-term view, Matt. It's the same narrative with both fiscal stimulus as it is with the vaccine narrative. We all know that the short-term challenges seem to be getting worse, whether it's with infections or the lack of fiscal stimulus agreement. But markets really want to look, 3 to 6 months forward, and I think there is still a very high expectation that vaccines will be delivered and that ultimately Congress will get its act together to push something through. So I think there's still a decent amount of taking things on faith that the markets are leaning on.
Are US stocks still overvalued, and would you be acquiring more at this particular moment in time?
So the way we have framed that, Matt, as we look ahead to 2021 is that we don't see a lot of value in US asset prices. And what we have selected to do as an alternative is focus much more on EM, and that applies for fixed income, for credit, and for equities. We think EM equities are very cheap relative to the S&P. We think the EM assets on the fixed income and credit side and currency side also look like good value on a relative basis. So we'd be avoiding US assets, including the dollar, by the way, and focusing our attention elsewhere.
Where do you see value other than emerging markets?
And another place that we see quite a bit of value actually is in the commodity space. Now, somebody might say, well, gold, recently hit $2,000 an ounce, and copper has rallied, well over 50% from the lows. But if you think about the environment that we're living in, we're seeing record amounts of fiscal stimulus, monetary stimulus continuing at quite a pace as well across both DM and EM. And so it's really going to feel in many ways like a post-war recovery next year. And we think that argues extremely well for infrastructure, commodities, and commodity-linked assets. So I think along with EM, the commodity space is going to be very interesting and appealing for next year.
Yeah, oil prices at around a 9-month high. Is oil perhaps looking a bit expensive given the demand outlook as it stands right now? And of course, in the last week or so, we've had warnings from OPEC suggesting that the demand story is not going to be as strong as what it originally thought.
Look, this is a really important point, Matt, and I'm glad you raised it. The supply-demand equation for oil would suggest an oil price of right around current levels, somewhere in the mid to high 40s for Brent. Now, one of the things that we think is interesting and where there is potential sort of surprise value is if the vaccines really do start to get deployed and put into play by the middle of next year. The demand for energy from a tourism point of view, travel, et cetera, global trade, we think there's quite a bit of optionality to the upside, again, as long as OPEC participants don't start flooding the market with oil. So you're absolutely right. Supply-demand equation at the moment looks a bit, shall we say, uncertain, but I think there is potential for an upside surprise.
What about the gold rally? Is that well and truly over? We did see prices up by about 1.5% overnight, again on these stimulus hopes.
I don't think gold is finished. There's obviously been quite a bit of focus on people selling quote-unquote safe haven assets as people get more confident in the economic and market recovery for next year. But I don't think gold is done. Gold has rallied because central banks continue to expand their balance sheets. There remains an historical amount of excess liquidity in the system. And if people are diversifying out of US dollars, which has started to pick up pace over the last few months, gold remains an extremely attractive asset. The final point I would make is that real yields in the United States or inflation-adjusted yields remain deeply in negative territory. And that historically has been a very powerful leg of support for gold prices.
Let's go back to your top pick. You mentioned it earlier, which is EM. EM, where is it, in Asia or elsewhere?
Look, if we put our economic hats on for a moment, the bulk of the economic recovery that we have seen so far has been in Asia. And if we look to 2021, that remains the case. We see growth in Asia, including China, being the engine for the global economy next year. There's also a number of markets in Asia that offer quite appealing nominal yields, whether it's India, Indonesia, China as well. And so I think that, from an economic and a financial market point of view, Asia really is going to be the leader, certainly for the first few quarters of next year.
Eric, we are going to continue this conversation in a moment, so stick right there.